Hello, today I'm going to go over some ideas about portfolio building. We've talked a lot about individual securities, we've talked about different markets and the economy, but generally investors are thinking about their investments as an overall portfolio. Now, everyone's needs and tolerances are going to be extremely different when approaching building a portfolio, so I'm not giving any specific advice on what should be bought. Every unique investor requires very different things for their portfolio. But investors over the years have come up with a lot of different ideas about how to approach building a portfolio. So I'm going to go through some different ideas and theories that have been developed over the years by people going through that same decision-making process. The first is quite general. It's the idea of a portfolio perspective. In the portfolio perspective idea, the idea is not to think about individual investments as unique and granular, but instead parts of a comprehensive whole. The investment is the portfolio, and the way the different components interact with each other says a lot about that portfolio and sets up where you are. The idea here is that every investment is going to play a role in developing the portfolio, and how they all interact and come together is what should be ultimately focused on. Instead of a group of investments, the portfolio as a whole is what is kept in mind. It's like thinking about a cake instead of thinking about flour, sugar, and eggs. This doesn't mean don't think about the individual investments, but think about what are they doing together. When they come together in a portfolio, what are they doing as a whole? One of the biggest key elements of that is diversification. And the core idea of diversification is don't put all your eggs in one basket. Someone might believe that they've found a fantastic investment opportunity, but one macro change, one idiosyncratic change, just one little thing going wrong could take down the whole portfolio if it isn't diversified, since everything is dependent on one thing. This can also be expanded out to one sector, one type of stock, one type of bond, and could mean investing in multiple asset classes that move in different ways from each other. The level of diversification and how it is set up will change between different investors, and there have been successful investors with extremely concentrated portfolios. But this is very uncommon, and most investors have some level of diversification. But the idea always comes back to that same premise of don't put all of your eggs in one basket. Now, that's primarily done to offset some degree of risk. One of the most common ways risk is measured is by volatility, which in the technical financial use is the dispersion of returns for a given security. Many investors often associate volatility with risk because if you are unsure of what you'll be able to sell an asset for, then that has a degree of insecurity in a financial sense. If prices move around dramatically, then you won't be able to know if you can necessarily sell it for the amount of money that you need. Some investors instead consider risk to be downside risk and measures of downside movement. So what is considered risk changes from investor to investor. But it is extremely common that volatility will be cited as a primary risk, because volatility means a lot more value uncertainty, and that value uncertainty, well, that's a lot of insecurity. So very often when an investor is setting up a portfolio, it is common to try to get the expected volatility of the overall portfolio to a level that's acceptable to that investor. Now, that risk has to be thought of in conjunction with return, as an investor is likely to have a return target or a return that's needed in order to satisfy some liability. And generally, different types of assets are thought to have different risk premia. There are safer assets, which are generally less volatile and have less risk, but are expected to offer less of a return than a more risky asset. An example of this would be stocks being a riskier asset class when compared to, say, treasury bills. An investor who does not need a very high return and has a very low risk tolerance might be more likely to invest in the treasury bond, while an investor who is willing to take on more risk and also requires a higher return might be more likely to go into the stock market. So you see that general trend of higher expected returns only come when additional risk is willing to be taken on. And unfortunately for an investor with very low risk tolerance, they'll have to expect lower returns than an investor who is willing to take on a higher degree of risk. These are some of the most important questions that wealth managers try to ascertain for clients: what their risk tolerance is, and what their ability to take on risk is, as well as what their return goals are. And there ends up being generally a trade off between the two. When we're thinking about the idea of diversifying investments, the ideas of co-movement and correlation become quite significant. Imagine you're investing in commodities and you are invested in wheat right now, and you want to branch out into other commodities to diversify your portfolio. Well, things could look very different for you if you went into copper versus if you went into barley, for example. Since some investments are more likely to move together than others, an overall change in the demand for grains as a whole could affect both wheat and barley, but wouldn't affect both wheat and copper, since copper would be more affected by changes in the demands for metals and electrical components. So how different assets move together can be a very important thing to think about when approaching diversification. Now, there is historical, statistical research that's out there that has attempted to build tables of how different assets have moved together in the past, but that's no guarantee of how they will move in the future. Different macro events can cause different things to move together at different times. An overall change in the demand for grains could change wheat and barley at once, but what about a disease that only affects barley? Well, that wouldn't touch wheat in the same way. So an investor has to think about what risks they are concerned with and think about what assets they have in the portfolio might both move in the same direction together if those were to happen. Now, say an investor were concerned about interest rates rising. They might not hedge out their stock position by going into bonds, but they might go into something like floating rate debt. But on a more general long-term level, there are different assets that tend to move in different ways from each other. That's most commonly thought of when considering correlation at portfolio perspective for diversification, since highly correlated assets aren't able to offer the same diversification as assets that are generally uncorrelated from each other. Also, some assets tend to be negatively correlated with each other, which could be a consideration in some instances. Now, the 60/40 portfolio is something that a lot of people have generally heard about. It's a 20th century idea that gained a lot of popularity, with the idea of having 60% equities and 40% bonds, with the idea of this split being the basis of diversification. Now, this approach has lost a lot of popularity, especially as interest rates significantly decreased over the second half of the 20th century, but I'm using this as the basis to introduce some common heuristic ideas that people have developed when approaching portfolio construction. There are a lot of these simple rule portfolios that have gained popularity at different times, other ones being 100 minus your age for equity allocation. Now, that's not to say that this is a bad portfolio allocation, but these simple ruled heuristic portfolio concepts have lost quite a lot of popularity over the years, and now more personalized, bespoke portfolio allocations are much more common to see, as more nuanced needs of different investors have become more carefully considered when building portfolios. One very common thing that is seen is a change in overall portfolio allocation at different times, and this has notably been the basis of target date funds, which are designed to change allocation slowly as the target date of retirement approaches, as is common in private wealth management of retirement funds as well. One of the most common forms this takes is to begin with a more equity-heavy, riskier portfolio earlier on, and then slowly allocate more and more toward fixed income and away from equities over time as retirement approaches. Liability matching is most commonly seen in institutional investing, particularly with pension funds. I can make a video to go further in depth on how this is done, but the idea behind it is to set up assets in such a way that they will pay out what is needed to match a particular liability over time. One form this could take is duration matching, where the fund buys bonds in such a way that the bond payments will be able to be used to pay back the liabilities that the fund has taken on, matching the duration of fund assets with the duration of fund liabilities. This approach is less common with personal investing, but could certainly be employed if there's a certain liability that needs to be met. Risk parity has generally been a hedge fund strategy, but has begun to be employed by more managers. The idea is to equally diversify the sources of risk in a portfolio. To give a simple example of how this could be done, imagine there are two types of asset. There's asset class A and asset class B. Now, asset class A is half as risky as asset class B. Well, then in a risk parity portfolio, the portfolio will be made up of 2/3 of asset class A and 1/3 of asset class B, so that the half as risky thing, there's twice as many of it as the one that's twice as risky as that, making the whole thing half of the risk borne by class A and half of the overall risk borne by class B, spreading out that risk so that there's parity. This has been done in very quantitative and more sophisticated ways, but more simple versions have also been employed. And it all goes back to that same core diversification idea, where here it's let's match the risks off against each other, thinking about each asset class in terms of its risk profile and how much risk it contributes to the overall portfolio. In future videos, I'll go further into the ideas of modern portfolio theory, but just to generally introduce the concept right now, the idea is that each asset and its risk and return profile should be thought of in terms of how it contributes to the overall portfolio. In this approach, an investor's level of risk tolerance and ability to take risk are taken into consideration as the maximum level of acceptable risk. Now, from that point, the assets are thought of in terms of how they can be put together up to that level of risk. And the one that offers the largest level of expected return without exceeding that level of risk is thought to be the most optimum portfolio for the investor to build. The Sharpe ratio is often employed to show return relative to risk. The Sharpe ratio is made up of the return on the investor's portfolio, subtract from it the risk-free rate or the rate of some benchmark, then divide that by the standard deviation of returns of that portfolio. Since we talked about volatility earlier, we're thinking about that standard deviation of movement. How much extra return above that risk-free rate did the investor get relative to how much movement risk was taken on, that standard deviation of movement, the volatility? How much extra return was achieved compared to how much risk was in that portfolio? And this metric is often employed to show how good a portfolio has been at achieving return when comparing to how much risk it took on. If it took on an extraordinary amount of risk and got reasonably good returns, how does that compare to something that got solid returns but exceedingly low risk? Well, since that's sort of an arcane thing to consider, this is how it can be quantified in mathematical terms, with the idea that a higher Sharpe ratio means that more return was achieved compared to how much more risk was taken on. It's very common for investors to diversify their portfolio, not by picking a whole lot of individual securities, but by instead investing in pooled funds. These are things like ETFs and mutual funds, where having a share of that fund means having a share of a pool of a whole lot of different securities. For example, having one share of an S&P 500 index fund would be equivalent to having a real small amount of all of the companies in that index. And this allows an investor to invest in many different assets at once without having to buy them all individually, potentially getting the diversification benefit of buying a whole bunch of different securities without having to actually go out and buy a bit of all of them. And there are a whole lot of different funds out there. Active funds are funds where a manager will actively pick different securities to invest in. And the manager could do this to achieve a whole bunch of different goals, either to maximize returns to as high as possible, or to stay at a very particular level of risk, or perhaps to follow a specific trend. There are many different goals a manager could have, but at its core, an active fund is based on the decision-making of that portfolio manager, who might not touch it all that often, or could be trading all day, every day. It comes down to what that individual manager is trying to do. Passive funds, on the other hand, follow a rule. The most common form is an index fund, where the manager buys assets to track an index as closely as possible. The decision making isn't on the manager, it is on the rule that says follow what this index is. In an S&P 500 index, for example, it's not down to what the manager thinks are the best stocks, it is what tracks the S&P 500 index. And there are funds for many different indexes out there, and there are different passive funds than just index funds as well. And at their core, this is the rule, and this does not come down to the manager's decision making. Maybe it's we just hold gold, or we buy all of the companies in the Russell 2000 that are in the tech sector. There's a diverse array of passive funds, but at their core, it is not a portfolio manager making decisions, and instead, this is the rule that the fund follows. Before going into any of this, it's very important for an investor to figure out what their risk aversion or risk seeking is. And a lot of study in behavioral finance has shown that investors misjudge their level of risk aversion very frequently. It's very common for wealth management clients and individual investors to believe that they're able to take on a high level of risk only to very suddenly panic when they actually see that risk manifest. So this can be a very difficult judgment, since very often people don't know what their actual risk tolerance is. But an investor's ability to take on risk, whether they want to avoid it or want to take on as much as possible for the possibility of returns, is very fundamental in the building of a portfolio. The last thing I want to touch on in this video is leverage, and leverage is the use of borrowed funds to invest with. If successful, leverage can greatly magnify the returns for a portfolio, but they can also mean enormous loss, bring the investor down to a negative value beyond even just the portfolio going to zero. So leverage can be thought of as a magnifier, potentially much greater returns, but a much higher level of risk. Frequently, an investor using leverage from a broker will get margin calls where the investor will have to put up more capital as an underlying investment decreases in value. And if a levered investment goes down in value, then that can spiral downward very quickly. So I'm not going to say leverage is a good or bad strategy for anyone, but it is one to be extremely careful with. Very often investors get lured in with the hope of very high returns only to find themselves absolutely crushed. So their position, their level of leverage, and the risk of the underlying investment are all things to be extremely careful with and to remain on top of for an investor employing leverage. Leverage can magnify gains and can magnify losses, and there have certainly been quite a great many people who have been absolutely crushed by misjudging when using leverage. So that's this one, and I'll be visiting this topic more in future videos as I go more and more into finance. So do like and subscribe if you're interested in seeing more of these. So, until then, have a goede dag.